Alright, today we are taking a look at West Bancorporation. It's headquartered in West Des Moines, Iowa, with a ticker of WTBA. And over the past year or so, it's had some ups and downs, but now it's kind of at the bottom of where of its trajectory over the past year. So let's take a look at some of its prospects. It's a pretty small bank. Its market cap is about 284 million, and it's not priced very cheaply either. It's about a 12 PE. And if we come over to the statistics, we can tell a little bit more about that. So, the PE of 12. Price to book 1.27. That's a little bit high compared to most other banks in its area. Return on assets 0.58%. That's pretty low. Usually we'll see something around 1 to 1.3%. Return on equity is pretty low as well. We might see something about 12 to 17. So already we can kind of see that the bank isn't really priced in a way that might reflect its profitability and its net assets so far. But let's dig into the financials and see if we can figure out why. Alright, so going down to the balance sheet, there's only about $4 billion of assets, which is a really small bank. Out of the 300 banks that we study, they're usually in a range of somewhere between 5 and 15 billion or so. So this is a little bit below that range. And the amount of loans and securities that they have, so they've got securities here and loans. It's about average for what a percentage of assets for most banks. So their allocation to the various assets is about normal. And I think that what might be abnormal about this bank might be on the liability side. Their non-interest bearing demand deposits are really low as a percentage of their liabilities compared to most banks. And so the non-interest bearing deposits, they don't have to pay interest on them, right? So it's basically free money for them to lend out. But for this bank in particular, they have a lot of debt, which debt represents about 17% of their liabilities, which is higher than most banks. They also have a high amount of interest-bearing deposits as well. And so what happens is as interest rates increase, then these types of liabilities, the deposits will reprice soon, a lot sooner than the assets do. So that might be why we see such a low return on equity and return on assets for the bank. But also what we see is pretty high amount of debt for the bank, which is about 17% of their liabilities, and that's a lot higher than most banks. So it turns out that from a leverage standpoint, the bank is a whole lot more leveraged than most other banks. The assets to equity is about 17 or 18 times, which is really high. Most banks end up somewhere around 10 times. So they've got a lot of deposits and debt here and leveraging up their balance sheet, but they're also having to spend a lot of money on the interest for these liabilities, which is, I guess, maybe causing them to get squeezed a little bit relative to most banks right now anyway. And then coming down to the income statement, so keep in mind this is the first quarter of 2024, so yeah, if you want to annualize everything, you basically just got to multiply it by 4. But we got their interest income here, interest expense, and then non-interest income, non-interest expense. If you were to look at this in comparison to other banks, you would find that this is their net interest income is really, really low, most other banks. So this net interest income number of 16 million is about 1.7% of its assets. So most banks you might see making about 3% of the assets. So I think this is maybe a characterization of what we were talking about earlier, where a lot of they're really highly leveraged, but also a lot of their debt side is interest bearing. So this interest expense is about 3% of the assets, and that is a lot higher than most banks, which comes in maybe around 2% of the assets. So that's why we're not getting as much of a net interest income here. But also their non-interest income is really, really low. This is about 5% of the interest income. Most somewhere between 10 and 13%. So, not only do they have pretty low net interest income, but also really low non-interest income. I think the only thing, kind of keeping them together is that they've got really low expenses. So the non-interest expense is about 25% of its revenue, whereas most banks end up somewhere between 40 and 50%. So they're saving a lot of money on salaries and occupancy and stuff like that, but they're not making as much money on net interest income or non-interest income. So all this results in pretty low net income number. And if you were to look at this 5.8 million, compared to the market cap of the company and multiply it by 4, it's basically an earnings yield of about 8.3%, which is pretty low. Most banks currently would have an earnings yield somewhere between 9 and 11% or so. So this being 8% is pretty low earnings yield. So if you were to buy the bank at this market cap, you'd be buying pretty low yield. And there are other banks that are yielding a lot more than this. But we can kind of go through the footnotes and highlight some of the other important areas as well. This is the composition of their securities. They've mostly got mortgage-backed securities, collateralized mortgage obligations, those types of things. And you can see that they're in a significant unrealized loss position, 735 versus 605, and that's characteristic of all banks. So not something that should deter the purchase of this bank in particular, but it's important to note. And also the available for sale securities are held at fair value, so these have already been adjusted down to the fair value amount. You might see some other banks that have a lot of held to maturity securities, and those aren't adjusted down. So if you want to kind of compare apples to apples, you would have to take that into account. But fortunately for us, this one's already been adjusted down, so it can the loans aren't at a fair value amount, but we can look at that in a separate footnote. One of the things that is perhaps tough for this bank, and a lot of why it's getting squeezed from a net interest margin perspective, might be that a lot of its securities are long dated. 5 to 10 years is this. After 10 years is this. We're not exactly sure how much this the maturities for these or when they reprice, but as it is, these are far out there. So as interest rates have increased over time, the securities have taken a pretty big hit, and they won't reprice for another 10 years or so. So that means as its deposits and debts reprice, as interest rates go up, and then these securities stay the same low interest rates of 2-3% or so, they're going to get squeezed over time. And that's why we've got such a big loss here. So a lot of banks lately have been selling these securities that are in the loss position, so they can reinvest them at higher rates. But these guys, I guess, are holding on to them for a little bit. All right, so now we're down to the loan. So we can see here the composition of the loans. The majority of it is commercial real estate. It represents about 65%. And then secondly is the commercial loans, so loans to businesses and such. So we can see most of the loan composition is commercial, so that's loans to businesses or some kind of business's real estate. And those carry their own types of risk, but the 65% of commercial real estate is a little bit higher percentage than most banks. But you'll see this composition for most banks is pretty customary. The good thing about the commercial type loans is that they reprice sooner than perhaps retail like loans. For instance, a 30-year mortgage might not reprice for a long time. So that's good in light that we are concerned with the liability side of the balance sheet repricing really fast. So at least maybe some of the loans reprice quickly as well. But we can also take a look at what is the loan quality now. We got an allowance of 28 million currently, and that's about 0.95% of the loan, which is a little bit low relative to most banks. Most banks they'll have an allowance somewhere between 1 and 1.25% currently, but as we see down here, it might be reasonable for them to have such a low allowance because they basically have no past due non-accrual type loans. Or the ones they do, it's maybe 300,000 out of $3 billion of loans. They've only got $300,000 that's not accruing. There's no past due loans, so right here they're all paying on schedule, and they also have no substandard loans except this 300,000. So really, these guys have accrued almost 1% of their loans as an allowance, as a reserve in case any of them default, but and have a loss from that default. But basically none of the loans are at risk for default right now. So they've really kind of over accrued for loan losses, I feel like. So you could equate that for in the past they recorded too much of expenses or too much losses in their income statement when they could have presented perhaps higher net income for those years. But so that gives me it makes me feel good about the reserve that they have and that they have been really, really conservative with it. But it's also interesting that there are very, very, very few banks that have no substandard loan, no past due loans, and so either their underwriting process is really robust, or it's just kind of the nature of the bank is located in Iowa and Minnesota, so maybe they're just really selective with who they decide to do business with. But either way, that's a good quality for the bank. Same thing here, no collateral dependent loans. So this would be loans where they're expecting to be paid off with the collateral rather than being paid back by the loan. So all very good credit quality type stuff. Another good thing that they're doing is these hedges. So these are cash flow hedges. They've got 515 million notional amount on these, and they're basically hedging the liability side of the balance sheet. So as we were talking about earlier, they are at risk for repricing of the liabilities. So as interest rates go up, they're having to pay more and more interest sooner. And so these hedges are hedging that risk. So that's a really good policy for the bank to be doing. So that kind of helps them in their interest rate risk. And finally, the fair value measurements. So I have a footnote down here that compares the fair value of the various balance sheet items to what it's presented at on the balance sheet. We talked about earlier the securities available for sale are carried at fair value on the balance sheet. So the only thing that's really going to be different on the asset side is the loans. So you can see that the fair value of the loans is about 2.8 million, but on the balance sheet it shows 2.9. So when we're thinking about price to book type ratios, we might consider that hey, these loans are actually worth a little bit less, and that's because interest rates have gone up. So you're earning less interest on these loans than what they could be earning with new loans coming out. So we've got sort of a unrealized loss inherent in these loans. So depending on whether the bank sells these or not, they would realize that loss. But yeah. So then on the liability side, there's kind of the same thing, but not as pronounced as the asset side. Some of the notes and deposits, like CDs and stuff, might have a small fair value difference than what it's carried at. Because as interest rates go up, the fair value of these loans goes down as well, because the company is not having to pay as much interest on the loans than what if they had initiated that loan today. So they're getting a good deal. So this goes opposite to the assets. So anyway, if you were to kind of adjust the assets and the liabilities to fair value, you would end up with about a 2.1 price to book ratio. So that means if we were to go buy the bank at the price that it's at today, we would be buying it at 2 times its net asset value with everything adjusted to its fair value. So that's within the normal average range for most banks. It's a little bit on the high end. And I think that's mostly because of what we were talking about earlier, how the bank is really highly leveraged compared to most banks, but it's still within the average range, so not that unusual of a ratio. So by buying the net assets, we get sort of a normal average ratio, but if we're buying the earnings, as we talked about earlier, we're getting about an 8% yield, which is a little bit low. Especially faced with the risk that we talked about with having a high amount of earning liabilities and interest rates going up and the company getting squeezed and all that kind of stuff. So there's a lot that could be said about that, but I feel like the 8% yield on the earnings is not high enough to justify the risk of the earnings going down over a period of time. And some helpful things down in the MD&A. They got the return on average equity. It's pretty low compared to most banks. The efficiency ratio, I think, is in the range of the average bank. And so we talked about earlier how they're not making as much on net interest income, but maybe making up for that a little bit with lower expenses. So the sufficiency ratio compares the expenses to the total revenue. So most banks have an efficiency ratio of somewhere between 60 and 70. So that's pretty good. But what's not good is the net interest margin. It's about 1.88%. Most banks have somewhere around 3% currently. So they're having to pay a lot on the interest expense side for their liabilities. So, and then to speak a little bit to the leverage we were talking about earlier, this equity compared to its assets is really, really low compared to most banks. Most banks are somewhere between 9 and 10% on the equity to assets. So these guys are really leveraged. They're not making as much as the average bank because they're getting squeezed on the liability side. So there's a lot of risks here, and not making as much money relative to the market price currently. So you can see a lot of what we talked about in this chart as well. These are the yields on the loans, securities, interest-bearing deposits. So there, and then as well as the liabilities like the deposits and the debt down here. So you can see from the assets as a whole, or at least the interest-earning assets, they're making about 4.99% on average. And then from the liability side, they're paying 3.7%, and that makes their net interest margin of about 1.88%. And so this 4.99% is pretty average for most banks. Most banks right now are probably like 4.75 to 5.5%, something like that, from their assets as a whole. But the liability side of this 3.7% is way, way higher than most banks. Most banks somewhere around 2% on their liabilities. So that's why we're kind of getting squeezed on this net interest margins, which should really be up around 3% for most banks. So not a very profitable bank from the net interest margin perspective. Then we see a little bit of the non-interest income. There was a death last year, which gave them a death benefit in their BOLI, but this year that wasn't present, so a little bit less than last year. And then from the non-interest expense side, it's pretty comparable. But as we talked about earlier, it's a lot less than most banks. And as we talked about earlier, the non-performing assets is pretty low. From the deposit side, they don't really mention it here, I don't think, but the uninsured deposits that they have make up about 50% of the deposits, which is actually a really, really high amount. So that means there's a risk that there could be some deposit flight if the ones that are uninsured are a little bit more prone to switch banks. So there's that risk there as well. And then from the borrowing side, as well as liquidity, most of the borrowed funds that they have are very short term, either overnight type stuff or that reprice really quickly. So as interest rates have gone up, then those have gotten higher and higher interest rates. And from a liquidity standpoint, usually try to look at how much can they still borrow, considering what they've already borrowed and what their borrowing capacity is with the FHLB and the Federal Reserve and that stuff like that. And so currently they could borrow about another $600 million if they needed to, based on the collateral that they've posted with those wholesale banks. And that represents about 71% of their deposits, which is a little bit low compared to most banks. Most banks would be somewhere between 75 and 80. But as we spoke to earlier, they're pretty highly leveraged, so perhaps aren't in a position to borrow much more, at least compared to other banks. And then their on-balance sheet liquidity, so stuff like their cash, unencumbered securities and loans and stuff, represents about 12% of their deposits, which is also a little bit low as well. We might see somewhere between like 13 and 17% of those on-balance sheet liquidity compared to their deposits. So these guys, not only the on-balance sheet liquidity is a little bit low, but also the off-balance sheet liquidity, so the stuff that they could borrow from FHLB, etc. So, and that's partly, I think, because they're so highly leveraged. And this is also a little bit reflected in some of the capital ratios. Their leverage ratio is 8.36. The common equity tier 1's 8.67. Those are both really, really low. Actually, all of these are really low compared to most banks. This is the regulatory capital ratios that they're supposed to meet. I mean, they're in compliance with the above which that they're supposed to have, but compared to other banks, these are really, really low. I think it's partly due to the leverage that they have, but also they've got a whole lot of commercial loans, which might be hit a little bit harder in the risk weights. So not only from a financial standpoint, but also from a regulatory standpoint, this bank is a little bit riskier than most banks, at least from a capital standpoint. And then what's also really concerning is the interest rate risk here. So it says if interest rates rise by 300 basis points, you're looking at a 17% loss on net interest income. So that's a really, really big hit compared to most banks. And I think it's due to what we were talking about earlier, where a lot of the assets are long-term in nature, like the securities, but their deposits are a lot more short-term in nature. So as interest rates go up, then they're going to get squeezed on the net interest margin, which is what we've already seen. So, and that will continue to exacerbate as interest rates increase, if they do continue to increase. But so that's the gist of it. I think that the bank is not very profitable at the moment, due to getting squeezed on the net interest income side, and so that's making the price on its earnings be a little bit too high. And also to add to that, the risk from the interest repricing side makes it to where it makes the price even higher than what it should be. I would want to pay a little bit lower of a price for the company, given that interest rate risk and its current profitability level, and as well as the capital risk, and that it being a little bit over leveraged. If they've got to borrow more money, that could create even more expenses from interest side and all that. So there's a lot of risks of the bank that I feel like are not reflected in the market price. It's really only redeeming quality is its credit risk, where they basically, all their loans basically have no past dues, basically negligible non-accruals, all that kind of stuff. So they've got really good lending standards. I just think that from the liability side of the balance sheet, they've got a lot of risks there. So yeah, that's where it stands. I think that the price should be a little bit less due to all of those metrics.